How's it going today? All right, so NEO's just released a new international markets covered call ETF, and I want to chat through what it looks like. It is super new, but we can use some other benchmark funds as a comparison. So let's just jump right into it and look at this new fund. All right, guys, first and foremost, I want to shout out the Patreon community. Guys, we're up to 68 members, and I really want to keep growing this channel and this community. If I'm providing great value, guys, if you want to buy me a coffee, it's $5 a month. You get access to all the calculators, or if you want to do a quick financial coaching session, it's $15 a month. I'll leave the link in the comments below, but if you want to join the Patreon community, please jump in, and we'd love to have you. So thank you for that. All right, folks. So NEOS has launched this new MSCI EAFE high income ETF, and the ticker symbol is NIHI. All right, so it is going to track the MSCI EAFE index, and I'll show you what type of funds and what type of allocations holdings are within that. But primarily, it's some of your mid cap and large cap international stocks and international companies that exclude the U.S. and Canada. All right, some of the benefits of this fund, as per usual for NEOS, they're looking to drive monthly income, in this case with international markets, as I mentioned, excluding the US and Canada. These funds are generally very tax efficient, trying to return to you as much return of capital as possible, but where possible, also they're going to use what's called Section 1256 contracts, which is a tax optimization strategy that allows you to lower your tax rates. The fund will also look to ensure that there's as much capital gain as possible alongside the primary objective of seeking income. Now, these funds are super new, so they don't even have an estimate on the distribution rate as of yet, because this fund just came out, I believe, September 17th. So we're super new at this, but we can look at other funds as a proxy. And in terms of the expense ratio, we're looking at 0.68% for this. The net assets under management, $1.5 million. So it's super new. And if you're a first mover, maybe you look at this, but maybe you want to wait a little bit before jumping in. But ultimately, guys, I think that in any healthy portfolio strategy, we want a small allocation to international markets. Not financial advice, but for all of my portfolios I built, I want to have a small portion of international markets to hedge ourselves. We know that there is American exceptionalism right now, and certainly that's where a lot of the performance is to be found. But there are some great names internationally that could be considered as well. All right, and so some of those names that are interesting and I think should be potentially as part of a portfolio, ASML, SAP, AstraZeneca, Nestle, Novartis, Shell, Siemens, Novo Nordisk, Toyota, Sony, Mitsubishi, Unilever, LVMH, and a number of other industries, and it's certainly a longer list of assets, right? All international assets that you do not get exposure to when investing via the S&P or QQQ. Those are focused on U.S. Assets, right? So this gets you a little diversification in your portfolio. And we can look at its performance over the past 10 years and look at its average annual return to see, like, is this something that we want to hedge into? And so I'm using the underlying asset, the actual ETF that NEOS is buying into. And so we can see that since inception, it's returned a 7.4% return. Nothing fantastic. Generally speaking, international markets have lagged the U.S. market. That's no surprise. But is that going to remain constant in the future? We do not know. But it is good to hedge ourselves and be a part of pretty much all markets to ensure that we have exposure to the world and we're diversifying what we're doing. All right. And so having a small allocation to international, like I said, is a sound approach. And I think John Morgan would say the same thing. Looking at the past year, they see a total return of 20%. So in recent memory, it's been really picking up. And in the past 3 years, it has an average annual return of 15%. And I would presume the NEOS fund to be somewhere in line, maybe between, whatever this return is pulling, probably, in and around 1 to 3% of it in terms of its distribution. So if it's going to do 7.84% in total return, I would assume NEOS in terms of distribution and total return to be in and around 5 to 6%. If it's going to do 19% on average, maybe NEO should be 15% in terms of its distribution and total return. Looking at another ETF that has been in market for a little bit longer, and we can look to IDVO from Amplify. So IDVO, it looks to generate two income streams, one from high income ETFs from the international space, plus opportunistically write covered calls on those stocks as well. All right. And in looking at their performance, looking at IDVO's performance over the past 3 years, it's been decent, right? 78% in total return for IDVO. And the MSCI, the EFA, has done 66% total return. So IDVO, in terms of an international fund and a good performer over the past 3 years, it's definitely beaten that underlying asset that NEOS has invested into. And NIHI is certainly, of course, brand new to the market. It literally just came out like 2 days ago, so we really don't have track record against it. But IDVO is a nice comparison tool, a nice comparison fund that we could say, hey, this might be one that we want to hedge ourselves into and consider. And so for IDVO, we're looking at a 5% dividend yield on it, which is really healthy. And its expense ratio is also fairly reasonable for covered calls and others, 0.66%. And again, the total return, it has been, in any given year right now, right? Wow, over the past year, it's been 27%, right? Total return, okay? Price return, 20%. And then you tack on the dividend, right, of the 5-6%. And so, when did this come out? This came out, IDVO came out in 2022, so pretty much been out for 3 years. So really, we can only look at 3-year time period. And in that time, the European and the international markets have had a bit of a rally, so they caught a bit of steam there. But ultimately, guys, the objective here is the diversification. The objective here is hedging ourselves. In terms of my allocations, maybe it's 5 to 10% of my portfolio I'm allocating to international markets. But these are long-standing companies with great track records and decent cash flows. While the international markets have lagged, it's a great hedge for any portfolio. And so if you want the hedge and you're bullish on international markets, these funds are something to consider and add to your portfolio. And I'd love to know in the comments below if you guys have considered IDVO or want to jump in as a first mover for NIHI. I'd love to know in the comments below. All the best and cheers.